Hello, good afternoon, everybody. It's been a few weeks, and I am excited to be back at the Market Huddle here. Um, and such. So, hello, Wendy. Hello, Scott. I hope you guys are all well. Hey, you know what? This week we're going to be talking about 6 hidden risks that can threaten the financial security of your retirement. And when we start thinking about what risks we have in retirement, a lot of times what we think of risk as being only market risk is not necessarily all the risks that I believe that you need to be looking at with your retirement planning. So, there's a lot of other risks. There's risks that are often overlooked. There's taxes that we got to be looking at. There's skyrocketing costs of healthcare, long-term care, threats of inflation, low interest rates. So we're going to hit the top 6 here that I have. We'll talk a little bit about some of the options that as we see on how you can start to make sure you're addressing these in your retirement planning. And ultimately, whether you're an existing client of ours or maybe somebody has forwarded on one of these webinars and you would like to schedule some time to review your situation with our team, at the end here, as normal, we will make sure that everybody gets the opportunity to do that. So coming up on today's webinar, we are going to be talking about 6 hidden risks that you need to be keeping an eye on when it comes to your retirement planning. Looking at the number 1 risk that is out there that can be your biggest expense in retirement, as well as why living longer and a healthy lifestyle could be both a blessing and a curse. So without further ado, we're going to get going here. I agree with you, Galen. I don't know what happened this spring. We were running around almost in T-shirts here over the weekend, and now it came back. But we'll keep on the today's program, and then we can all start thinking about sunny weather again in spring. It's not that far out, actually. End of this month, I think, is already Easter. We got daylight savings in a couple weeks, so a lot going on there. Anyways, here we are. This is that disclaimer that we show here every one of these market huddles. Keep in mind, I'm not a CPA. I don't interpret tax code. We also are not attorneys. If we get into anything that talks about estate planning and such, keep in mind that we refer that on, or we can work with other professionals that can write legal language for you. I'm also not a representative of the federal government. So if we talk about things like Social Security Administration, in no way am I representing that I'm part of the Social Security Administration, but we are retirement planners. When we start thinking about the different levels of retirement planning, different levels of financial planning, I oftentimes see that we really need to consider 3 different ways that we can get the services that we want with our retirement planning. The very basic level at the bottom, or the most essential level, is really just those firms that are out there that allow us to help make transactions. We can buy and sell investments with them, but they really aren't probably going to give us a whole lot of financial advice. Think of your Robinhood account, which has been in the mail a lot, or in the news a lot lately, but it could also be a Charles Schwab account that you're self-managing, or a Fidelity or Vanguard account for that matter. These different accounts that they allow you to invest, but you don't necessarily get any investment advice. If I go up the level of services that you can get, the next level would be that level where we start to find advisors that are giving us financial advice. They're going to make some recommendations around our portfolio. Maybe tell us that we need to look at adding more fixed income into our account, or a little international. They kind of put together the models for us, and they're really more concerned about just the wealth accumulation aspects. Here at Secured Retirement Financial, I believe we strive to operate at that very highest level of service, and that's where we start to bring in these 6 core areas, these 6 hidden risks into your retirement planning. It's not just about the risk of losing money in the market. It also goes into things like our first risk here, looking at the impact of higher taxes, bringing in look forward tax planning, figuring out how we can reduce our tax footprint over time. And that really only comes when we start thinking of our financial planning more than just the wealth accumulation, but how to take the money back, how to make it tax efficient, how to make it last a lifetime. Tax experts are and economists, everybody's heeding this morning. And in fact, if you were paying attention over the weekend, you know that the House passed a $1.9 trillion stimulus package. It's on the Senate to, I hadn't seen that they signed it yet. I think they're expected to sign it late last night or this morning. Then it's going to go back because they were going to remove some things around minimum wages and such. But this $1.9 trillion stimulus, we can argue whether or not it's still needed. I can tell you that the other $2 to $3 trillion that's been passed definitely helped us move along. It doesn't feel like we're in a recession right now, but yet we have seen the economy with the COVID, come to almost a screeching halt, right? Well, with that said, this $1.9 trillion on top of the other trillions of dollars that's been passed, $30 trillion of national debt out there. And you can't find anybody, not a tax expert, not an economist anyways, that feels that tax rates can stay at these current levels for long. We are at 40-year lows. Go back here for a second. Let's think back to maybe about the time you were getting out of college or even out of high school. Go back to 1981. A lot of you think of 1981. It seems like just yesterday. Do you know what the federal tax rate was in 1981 as Ronald Reagan was coming into office? Today, the top tax rate is 37%. But in 1981, the top tax rate was over 70%. Now, there's a big difference between 37% and where we're at today and 70% where we were as many boomers were just starting out in their careers. And I guess I bring that up because I really think that there's a big opportunity right now to reposition our things so that we can take advantage or opt in this unique opportunity that we have right now to put ourselves in a better situation tax-wise. Now, that may mean that we have to pay a little bit more tax now, but I believe that the families that are bringing in tax planning with their retirement planning, it's not just about wealth accumulation here. It's about how do I save myself taxes down the road, which are sure to come after a $30 trillion deficit. This is the first time since World War II, or shortly after World War II anyways, where our national debt is actually the amount of repayment on the debt is greater than what we're generating as a gross domestic product, as what the economy of the U.S. is doing. It's scary times. They got their way out of this after World War II by really cutting back on services and government programs. And, I'm not sure that that's going to be the same path that they're going to take this time. So we need to start looking at taxes, start looking at how we can put ourselves in a better situation so that we can do that. And this unique opportunity, this 40-year low, is going to expire. If it doesn't expire by 2026, which most of you that have been on this know that is the date that the current tax law is set to expire without Congress interaction, then it's going to happen sooner. So we want to make sure that we're a resource here. We want to make sure we're bringing in tax planning because it's not just about wealth accumulation here. It's secured retirement. It's about how do we bring in the taxes, because if I can reduce your tax burden over time, it creates a whole lot less stress on the overall portfolios that you have set aside for your retirement. So at the end of today, if you aren't sure where you're at tax-wise, if you want to revisit your tax plan with us, let's schedule some time. Let's make sure that we're looking at this and see, let's revisit the planning that you have around your taxes, because my experience, very few families entering in retirement have actually gone through a process to reduce taxes and are thinking about that. And that's something that we believe really brings a lot of value to you, our clients, and those of you that are looking for retirement advice. Okay, let's move on here. We're talking this morning about 6 hidden risks that can jeopardize your retirement. And while I said earlier, it's not always about the risk of loss, the second risk, the risk of sequence of returns risk, is something that has to do with the performance of our portfolio. However, it's not necessarily whether or not we're in the right mutual fund. There are periods of time where it really doesn't matter where you are at, and we know that because you have exposure to the stock market, we will probably experience some losses. In other words, think about the retiree that was retiring just 1 year ago today. somebody that was retiring just 1 year ago today, keep in mind, we had just started talking about the impact of the coronavirus. There was rumors probably out there that we were maybe going to have to shut down businesses, the stay-at-home orders and such, but none of that was in place yet. We were still getting to that point, and here we were, that we had to experience almost a 40% drop between a year ago today and the next 6 weeks. When that occurred, there were families that were forced to dip into their savings, their retirement assets, the 401ks and IRAs, that were at 35 to 40% losses to maintain their obligations to spend. And what they did when that happened, unfortunately, is they were locking in losses, and they didn't recover like so many of the families that are working with secure retirement were able to do, right? Because all of a sudden they were taking money out of an account that was down in value. When we start to experience a downturn in the stock market or a bear market in combination of market losses, we need to make sure that we are protecting our your retirement savings from this event. If you're getting ready to retire, if you're in the golden decade between now and 10 years ago, or 10 years from now, you're looking to retire, make sure that you are protecting yourselves. You have assets set aside that do not have to experience market losses, whether they're short-term like the last one, or maybe a little bit more long-term like the 2008 or 2001 pullback, where we saw where we entered into a recession and it took a little longer to come back. We need to make sure we're protecting ourselves from these 6 risks. Some are hidden, some we might be a little bit more aware of, but the granddaddy of them all, in my experience, is the sequence of returns risk, not paying attention to making sure that we don't have exposure to market value adjustments, where we end up locking in losses because of something that we can't control, such as a pullback in the market due to either recession, could be an event like coronavirus, it could be a political event, it could be a lot of different things that create that. We need to make sure that we are looking at how to make sure we maintain our mailbox income, money that hits the checkbook each and every month, regardless of what's going on in Wall Street. So risk number 1 was around taxes. Number 2 was sequence of returns risk, protecting ourselves from retiring into a downward market. The third one is around healthcare. Ask yourself a question. Can we afford to pay hundreds of thousands of dollars for our healthcare throughout our retirement years? According to Fidelity, the brokerage firm, a 65-year-old retired couple needs to budget for $300,000, actually $295,000, almost $300,000 for a retired couple turning 65 today for healthcare and medical expenses. This does not include the potential cost of long-term care. So are you bringing this into, have we stress tested your portfolio? Do we know what would happen if we saw increases in our healthcare expenses, Medicare? One thing that we see right now is this IRMA, where people are paying higher for their Medicare expenses than other families because of tax events that might happen. Are we bringing that in? If you want to revisit this, if you want to look at how we stress test your portfolio, your income plan against the increasing cost of healthcare, schedule some time. Let's review some things. Also associated with this is long-term care. You know, how are we going to pay for long-term care? The old traditional methods were these, the old long-term care policies. You put they're expensive, but you put money in, and if you don't use it, you lose it. There are other surprising alternatives that are out there, such as maybe using life insurance as a way to fund long-term care, that are starting to be much more attractive for families like those that we serve here at Secure Retirement. So if you want to address some of those other options, let's sit down and look at those again together. The fourth, living longer, associated closely with healthcare. The longer we live, the more we're going to end up spending for healthcare, the more likely the possibility that we're going to need somebody helping us with our daily activities, whether it's, shoveling the walk after a little dusting of snow like we had this morning, or maybe somebody helping us, getting to the grocery store, delivering groceries, things like that. So the longer we live, the more some of these, it really can be kind of a catalyst for some of these other hidden risks. But we got to start thinking about this, because living longer can both be a blessing and it can also be a curse, right? We all wish to live longer, but what happens if it comes true? What happens if we see our older years and we need some assistance. Have we brought that into our situation? The average married couple, 65 years old, there's a 75%. That means 3 out of 4 families where I have a couple in my office that are both 65. 3 out of 4 has a probability that one of the two, that married couple, will see the age of 88. So we need to make sure that we're stress testing our income plan. Number one, let's see, God forbid something happens to the one of the two of you early on in retirement. Could the other one maintain their standard of living, maintain the lifestyle? That's very important. But on the other side of this, the other extreme is, what happens if you or both of you were to go to age 120 if you're married, or if you're single? What happens if you live to age 120? Do you have enough to make it out? And the additional costs that come associated with that. It's a real issue. In fact, we have far more people today than we've ever had walking the earth. There are more people living today that are over age 100 than have ever made it to 100, going back the last I don't know, 500 years, whatever it is, going all the way back to when they started keeping track of things like this. So the real cost, or the real possibility that we could see higher ages, and the planning that we need to be doing around that is important. If you're just joining us here, the quick reminder here on the Market Huddle, we're talking about 6 hidden risks that can threaten the financial security of your retirement. First one, I think it now is a unique time to plan around taxes. If you don't feel like we're doing that for you, let's make sure we visit on this, because this is such a huge, unique opportunity. And for the first time in many years, I see some clarity that we're going to start to really see this tax increases going up, and we want to plan accordingly. Number 2 has to do with market value adjustments. The third and the fourth had to do with healthcare and living longer. The next hidden risk I wanted to address has to do with low interest rates. I don't know the last time you were looking at a CD at the bank. You're lucky to find one that's at 0.5% right now. In fact, I was looking for another client. We were going out 5 years and only getting close to 1%. Interest rates are at record lows. We've seen some increases in the 10-year Treasury. I'm going to get to that in just a second, because that could be another indicator of something else going on. But we have to look at alternatives for low interest rates. In fact, I was reading Warren Buffett's letter to his shareholders over the weekend. Warren Buffett, Berkshire Hathaway released their results of their financials over the weekend. And Warren Buffett, it's a letter that he puts out to his shareholders each and every year, made this comment in his letter. He basically said, families that are looking at increasing their fixed income need to make sure that they're doing so with a certain amount of caution. Excuse me as I'm fumbling here. Says, bonds are not the place to be these days. Can you believe that the income recently available from a 10-year Treasury, the yield is 0.93. Now it's up to 1.4, but it had fallen from 94% from where we were in September of 1981. Said that there's some large and other important countries, such as Germany and Japan, where investors have actually received negative interest rates with everything going on. Says fixed income investors worldwide, whether pension funds, insurance companies, or he goes on, retirees, face a bleak future. Should we be looking at other alternatives for these low interest bearing fixed income accounts, these low bonds? We want to make sure that we're looking at that in your portfolio. If you aren't getting this advice and want to schedule some time to visit with one of the team members here, I encourage you to do so that we can help guide you on what some other options are. Finally, the 6th risk is one, as I said, as we see interest rates going up, it's an indicator that the markets, the fixed income world anyways, bond markets and such, are starting to worry a little bit about the cost or the real risk that we could start seeing rising inflation. Now, there's been inflation in certain areas that have exceeded what the GDP, what the cost of, what's used for or the CPI, what those numbers are that the government puts out. We know that healthcare has been rising faster, right? But other things have been coming down in value. We're starting to see oil prices go up again, and they've been coming down for the last few years. Rising inflation is probably now more important that we start to look at that again than it has been in the last 5 to 10 years. And if you think about it, this is what Ronald Reagan called the silent killer. Inflation starts to rob you of your buying power in retirement, and it's a situation where you got 1%, 2%, 3%. It doesn't seem like a big deal now, but over the next 15, 25, 35 years of retirement, it starts to really add up, and what was once affordable becomes something that is not able to be afforded, and that's something we don't want for any of the families we're working with. So 6 risks. I want to make sure everybody takes advantage of scheduling some time with us to go over these. If you want to reach out to us direct, you can email us at info@Secured Retirements, or you can call the office number there, 952-460-3260. Or if you want, you can just click on the link that should be popping up there. Schedule some time to visit with us. We'll set aside 15 to 20 minutes here just to kind of address the number one action step you need to take right now. Sometimes we just need to schedule or go over kind of the planning, or sometimes we want to maybe even go to another level and get re-engage some of the planning process. But whatever works for you. If you aren't currently a client and want a second opinion of some of these areas that we've been discussing this morning, do not hesitate to schedule that time. We'd love to be a resource. Jack, hear a lot about the Great Financial Reset. What is this, and what advice, suggestions? I think a lot of this, Jack, has to do, it's kind of a political discussion about some of the things that they're looking at doing. Some of it has to do with kind of almost, doing some things around more socialism and such. This would all be obviously negative when it comes to a lot of our finances. I think it's something we want to make sure that we are definitely looking at the cost of that. I believe that the United States is a very resilient country. Even though we sometimes lean towards more of a government sponsored type economy versus more of a straight capitalist, I think that, we kind of go back and forth. Also along the lines here is, kind of the devaluation of the dollar and such. All of these are somewhat risks, Jack, but I think that the real, if you believe, as I do, the United States is very resilient, I think that we're going to work our way through this. But we need to make sure that we're bringing it into our retirement planning. Let's look at what the real risks are out there. Which are the ones we need to be addressing? If you're a little bit more negative on that, there's some things we can look at. Should you be investing in some hard assets like cryptocurrency, or even looking at gold and things? There's a lot of different discussions we can have, and we just kind of want to make sure we're bringing them into your overall plan. And Bill, I agree with you. Maintaining our health is definitely something that we need to be looking at. So, with that said, everybody, I hope everybody has a great rest of your week. We'll be back next Monday, and look for a replay of this coming out. If you know somebody that can benefit from them, have them go ahead and forward it on to them. Let them watch the replay, and then have them join us next week for the live session that will be back next Monday at right at noon. So, everybody, enjoy the rest of your week and have a great day.